שלום, ביות שמדובר במיסוי אמריקאי, אני אדבר באנגלית. My name is Leonard and I'm the head of the U.S. Tax Department at Crowe, Horwath. FATCA, the Foreign Account and Tax Compliance Act, and the exchange of information agreements that have recently been entered into by the United States with other countries has compelled non-compliant U.S. taxpayers to begin reporting their overseas investments. This, for the first time, has given practitioners an opportunity to see how the implementation of anti-deferral regimes on investment income held outside of the United States, in the absence of bank secrecy, has removed all incentive for the individual U.S. investor to invest their money outside of the United States. The anti-deferral regime that I want to speak about today is called the PFIC regime. A PFIC stands for Passive Foreign Investment Company. A foreign company is a PFIC if 75% or more of its gross income is passive, meaning income from interest, dividends, and capital gains, royalties, etc. Another test is what's called an asset test, is 50% or more of the value of its assets consists of assets that are held to produce passive income. How is this relevant to all of you? As a practical matter, the IRS takes the position that all foreign mutual funds, all ETFs, and other structured investment products are PFICs. How is a PFIC taxed? The PFIC provisions apply to any U.S. person who owns directly, indirectly, or attribution an investment in a foreign corporation or fund that is considered a PFIC. So if you have a U.S. person, not necessarily living in the United States, but a U.S. citizen resident of Israel who owns a foreign mutual fund, which could be, any type of the Salim that are out there that are a primary component of the investment portfolios that we see today, they own what is called a PFIC. How are PFIC taxed? It's taxed by employing what's called an excess distribution regime, which means the total gain from the disposition of a PFIC stock is taxed in this manner. And it's taxed this way. The gain from the PFIC stock is divided by the number of days in the shareholder's holding period and then allocated as follows. Amounts allocated to days in the current year and amounts allocated to prior tax years. The amounts allocated to the prior year PFIC period, meaning if I sold a stock in 2014, and someone bought it, let's say, in 2010, the prior year period, I'm talking about the gain which is allocated to year 2010, 11, and 12, is taxed in the U.S. at the highest marginal tax rate for that year, regardless of the individual's normal marginal tax rate. And you're going to see examples in a moment. What am I talking about? So here we have various mutual funds. You can see we have an overall gain. Israel Mutual Fund 7, for instance. It was acquired January 20th and sold December 19th. $2,165 of that gain is attributed to years prior to 2013, and $710 is allocated in the current tax year. The tax for the amounts allocated to prior tax years is $758, meaning there's a tax rate of 35% on all gains allocated to years other than the current year. For the actual year, it's taxed at ordinary income rates. And you're going to see a very clear example of what happens with PFICs in a moment. So amounts allocated to the prior year are never included in investments taxable income. And in a moment, I'll show you what that means. And a gentleman asks a question, amounts allocated to the current year are included in taxable income and taxed at ordinary income rates. This next bullet point shows a very big disparity that affects U.S. citizens that are affected at the same time by both tax systems, the Israeli tax system and the U.S. tax system. Losses from the sale of PFICs are not recognized. They cannot be netted against gains from the sale of PFICs. And in a moment, I'm going to give you an example of what that means. So let's run through a fact pattern that is very typical for my clientele. Let's say we have an Oleh Hadash that emigrated to Israel in 2007. Under the current tax rules here in Israel, he has an exemption here on Israel from earnings earned outside of Israel for 10 years. He came to Israel because he married an Israeli woman. Now, this is a very important fact because this determines his filing status on his U.S. tax return. This actually has this fact here, being married to a non-U.S. citizen, and his filing status is going to very dramatically affect his tax liability at the end of the day. So these are the facts. He has total dividend from U.S. stocks, meaning he has dividends, U.S. source income, exempt from Israeli taxation for 10 years of $170,000. He has net losses from the disposition of PFICs of $67,827, and he pays no Israeli taxes. Why? As I'm going to show you what happens in Israel. He has an exemption on the $170,000 of U.S. source income. These are his mutual fund investments. He has an overall capital loss of $67,827. In Israel, you net capital gains against capital losses if you have an overall loss. Even though he's taxed in Israel on Israeli source income, he has no income here. It's a total law. So he has no foreign tax payments. This is his only source in this example of Israeli source income. He's paying no tax. But if you remember the previous point, in the U.S., when it comes to foreign mutual funds, the U.S. does not allow gains to be offset by losses. So all of those losses that we have there marked in yellow, he has no benefit from. He has a small benefit of a capital loss deduction of $1,500, as we're going to see. What is his U.S. tax liability already before we even complete his returns? On his $79,243 of gains, he's already looking at a tax liability of $25,851 before we've even gotten started. So let's take a look at a tax return and see what happens here. On line, we have the $170,000 of U.S. source capital gains, in which he pays no taxes in Israel. He has a capital loss deduction of only $1,500. When you have a net capital loss in the United States and you're an individual taxpayer, you're limited to how much you can deduct in a year. If he were married filing jointly, he could deduct only $3,500. He has $5,384 of ordinary income resulting from the gains of Israeli mutual funds that are allocated to the current year. That's taxed as ordinary income. So we go to the next page. He has a tax of $45,230. What is that tax comprised of? Without going through the complexity Without going through the complexity of the tax calculation, he had normal tax of $19,379 plus, and I'm going to try to go back to my slide here, plus the $25,851 of PFIC taxes that he is paying on gains allocated to prior tax year. And we're not done yet. If we can go further down, and this got cut off here, let's look at line 16. Now he has an additional tax liability of $7,115. Where does that come from? That comes from our good friend President Obama and his recent tax changes. He created in 2013 a new tax on net investment income. That net investment income at 3.8% has come into effect. Without going through the complexity of the calculations, let's take a look at what's happening here. There's a threshold. There's something called MAGI. There's a measurement which helps determine the base amount in which that 3.8% is taxed, and it's determined based on his filing status. As you can see, as we mentioned in our case, our new immigrant to Israel who fell in love with an Israeli woman can only file married filings separately. A U.S. citizen who's married to a non-U.S. citizen, unless he makes certain elections which would expose her entire global income to U.S. taxation, he's forced to file married filings separately. The threshold in these calculations for him is $125,000. Let's go through the return here. I don't want to bore you with how modified adjusted gross income is calculated. But if we take let's go to the middle section here and we're determine the second layer of tax. He has adjusted gross income that in his case, and I'm going to go back here, he has adjusted gross income of $173,884, line 38. He has from his PFIC a gain of $79,243. They take adjusted gross income, they add back the entire amount of the gain allocated to the PFIC in order to get modified adjusted gross income. Now, when I first saw that, and actually I was in shock because in 2013, the first client that I ever did paid an additional $60,000 in tax, additional tax than she paid the current year on more or less the same amount of investment income because of this new tax. They've added the entire 79-some thousand back, even the amount that's included in ordinary income on the current year. I thought that our systems had made a mistake. It's a new form. Sometimes they don't always get it right. But when I look back into the instructions of the form and how they expect modified adjusted gross income to be calculated under the tax, I saw that this is correct. They add the entire amount back. So now, $253,127 above his threshold by a filing status of $125,000, and he can only file as a single taxpayer. Look at the difference in the threshold between a married filing jointly, $250,000, and someone who has to file married filings separately, because he's married to a non-U.S. citizen. It's a different, married filing jointly is $250,000. Because he had to file separately, his threshold is now down to $125,000. He's taxed an additional $4,869 in net investment income tax, a total new layer of tax that never existed in the history of the United States until Mr. Obama became president. You take that together, we add that to the $2,246 of additional interest charges that relate to PFIC income. Our guy who made Aliyah to Israel in 2007 ended up losing $67,000 on the only investments he's ever made since coming to his new country, is now paying $52,345 in tax. Staggering, staggering. Now let's take a look at what happened with the same fact pattern, but everything being taxed as normal capital gains, meaning without the implementation of the anti-deferral regime for PFIC. Without going through the whole thing again, his bottom line tax liability is only $20,166. Okay? FATCA and the bank reporting of investment income to the United States has now led not only taxpayers but practitioners to look very closely at how we report investment income of our clients. There have already been cases under audit and currently under audit that I know about that they have asked practitioners here in Israel to provide the PFIC schedules, meaning they are aware of what PFICs are and they want to see something that looks exactly like this. This is actually a copy, although the numbers here I pulled out of the air for example purposes. This is what one of the schedules look like that we attach to our tax return. The IRS is very interested in the investment income and the type of income of its citizens. So for an industry such as yours, I think that there are opportunities here. One, to come up with investment portfolios that are American friendly, not only in the area of PFICs, but there are other issues such as pensions, developing pension products that can qualify as qualified pensions in the United States, meaning pension products that will allow the same tax-free deferment of income as pension plans within the United States. These things are possible. They're tricky. None of them have really been tested yet in the real world, but I think that the opportunity is out there. Thank you very much.